There was something in the air that year. Not a storm, not yet. Just a kind of quiet unease. The kind you cannot name but feel in the way people spoke less at the dinner table, in the way a neighbor suddenly packed up and moved away, no goodbye, just silence. From the outside, everything still looked the same. The lawns were trimmed, the mailboxes stood straight, and the porch lights flicked on every evening like clockwork. But there was a weight slowly gathering under the surface, like snow piling on a roof, quiet, almost beautiful, until it becomes too much. It reminded me of how a song starts to change key, just slightly before anyone notices. One wrong note, then another. And then the melody you thought you knew does not come back. People were still buying homes, still talking about the future, still quoting rising property values like gospel. But underneath all that certainty, there were papers being signed that no one truly understood. Promises made with borrowed time, and soon it would all unravel. The bubble grows. It began as these things often do, with a kind of quiet optimism. Not the loud firework optimism of the stock market boom in the 1990s, but something subtler. It was the early 2000s, and America was trying to find its footing again. The dot-com crash had shaken Wall Street. The attacks of September 11th had shaken everyone else. But by 2001, the Federal Reserve had slashed interest rates to historic lows, trying to keep the economy alive and breathing. Money was cheap. Borrowing became easy, and when money becomes easy, people take chances. Homeownership, already part of the American dream, started to feel like the safest bet in town. Prices were rising, fast. In 2002, 2003, 2004, you could buy a home in a sleepy suburb and just a year later sell it for more than you made in a decade of working. People started flipping homes like trading cards. You could see it in the way neighborhoods changed. Construction trucks on every street, for sale signs turning into sold signs before the ink dried. Banks too saw opportunity. If people wanted homes, they would find a way to get them loans. Even people who would not have qualified before. Even people with bad credit, no job history, or no income at all. There was a name for these loans, subprime, and they were everywhere. Mortgage lenders stopped asking questions. They started handing out keys. There was a loan product for everyone. Adjustable rate mortgages with low teaser rates. Interest-only loans. No documentation loans known on the street as liar loans. It did not matter how risky the borrower was. The goal was to close the deal, collect the fee, and pass the risk on. Because behind the scenes, another machine was humming. Wall Street had discovered a new kind of alchemy. They bundled these mortgages together, thousands at a time, and turned them into financial products called mortgage-backed securities. The theory was simple. If you put enough loans together, even the risky ones would be safe as a group, like mixing spoiled fruit into a giant fruit salad and hoping no one notices the taste. And investors did not just bite. They devoured. Pension funds, insurance companies, foreign governments, they all bought in. These mortgage-backed securities were stamped with high ratings by agencies like Moody's and Standard & Poor's. AAA, the same rating as U.S. Treasury bonds. Safe as houses, they said. But the rating agencies were not truly independent. They were being paid by the very banks that created the securities. And so the ratings flowed like champagne. At a wedding, no one questioned. Somewhere in the middle of it all, new jargon began to appear. Collateralized, debt obligations, credit default swaps, synthetic CDOs. Layers upon layers of risk hidden behind complex terms and pretty spreadsheets. It was not that no one understood it. Some did. But many more chose not to look too closely. After all, everyone was making money. Real estate agents were cashing commissions faster than they could print business cards. Mortgage brokers were getting rich off volume. Banks were swimming in fees. And regular people, nurses, teachers, warehouse workers, were buying second homes, vacation condos, even renting out places they could barely afford to own. It felt like the whole country had discovered a cheat code to wealth. But there were signs, always signs. Home prices were rising far faster than wages. In places like Las Vegas, Miami, and Southern California, the increases were dizzying. People were taking out loans that depended on home values, continuing to rise. Some borrowed more than the house was worth, expecting the value to catch up in 6 months. By 2005, some economists were sounding alarms. They warned that housing prices were out of touch with fundamentals, that lending standards had vanished, that risk was being ignored, not measured. But the music was still playing. And when the music plays, people keep dancing. By the end of 2005, the average American household was carrying more debt than at any point in history. Credit cards, car loans, mortgages piled on top of one another. Household debt rose faster than income, and still the bubble grew. Some looked around and wondered how long it could last. But most looked at their rising home value and smiled. Paper wealth felt like real wealth, and real warnings felt like background noise, because to most people it still looked like a good time. But under the surface, the foundation was beginning to crack. First cracks. The year was 2006, and something had changed. It was not dramatic, not yet. The headlines still spoke of record home sales, and interest rates were still relatively low. But if you looked closely, if you really paid attention, you could sense the shift. Homes were no longer flying off the market. In some places, they just sat there for weeks, for months. Prices stopped rising like they used to. In places like Phoenix, Tampa, and San Diego, there were early murmurs. Real estate agents started whispering that things were cooling off, and those whispers grew louder. In January 2006, the National Association of Realtors reported the first year-over-year decline in existing home sales in several years. It was small, just a few percentage points, but it was the first crack in the wall. Mortgage lenders began to notice something unsettling. Some borrowers had stopped paying. Not many at first, but enough. Subprime defaults began to rise. Now subprime loans were supposed to be risky. That was the whole point. But the system had been built on the idea that housing prices always went up. If a borrower missed a few payments, the house could be sold, the loan repaid, and everyone moved on. But what happens when the house does not sell? Or worse, when it sells for less than the loan? That was the quiet fear creeping through the financial world. In February 2007, it got louder. A company called New Century Financial, one of the largest subprime lenders in the country, stopped writing new loans. Within weeks, it declared bankruptcy. Suddenly, Wall Street firms that had been buying and packaging subprime loans were holding assets they could not value. Investors started asking questions. Rating agencies began downgrading bonds they had previously called safe. In June 2007, 2 hedge funds run by Bear Stearns collapsed. Both had been heavily invested in mortgage-backed securities. The losses were staggering, and for the first time, the word contagion entered the conversation. Because it was no longer just about bad borrowers in bad neighborhoods. It was about how deeply the bad debt had been spread into pensions, into mutual funds, into the global financial bloodstream. There were still people in suits on television smiling, saying it was contained, that this was a subprime problem and the broader economy would be fine. But behind closed doors, banks were tightening. Liquidity was drying up, and executives were trying to figure out how much they were actually exposed to. It turned out no one really knew. The complexity of the mortgage-backed securities, the layers of derivatives, the hidden risks they had all made it nearly impossible to trace the danger. And in the background, more borrowers were falling behind. More foreclosures hit the market. Entire neighborhoods once booming with construction and optimism started looking abandoned. By late 2007, housing prices were falling nationwide, not just in the overheated cities, everywhere. The dream was starting to unravel, and for the first time in years, Americans began to wonder whether the value of their home would ever go up again. The thing about a bubble is, it does not pop all at once. It hisses, slowly, quietly, until the day it does not. Panic on Wall Street. It was 2008, and the quiet fear that had been whispering through the halls of Wall Street finally found its voice. On March 16th, Bear Stearns collapsed. The firm had survived wars, recessions, and market crashes. It had been around since 1923, and now it was gone sold to J.P. Morgan Chase for just $2 a share, a tiny fraction of its former value. To the public, it was confusing. Most people had never heard of Bear Stearns. But inside the financial world, the message was clear. The system was cracking. Banks stopped trusting each other. The short-term lending markets froze. Overnight, borrowing something that had always been routine suddenly became impossible. Liquidity, that lifeblood of finance, was vanishing. In the months that followed, more names began to fall. IndyMac Bank failed in July. Fannie Mae and Freddie Mac, those massive quasi-government institutions that held or guaranteed trillions of dollars in mortgages, were taken over by the federal government in early September. And then came Lehman Brothers, September 15, 2008. A date that still echoes. Lehman filed for bankruptcy. It was the largest bankruptcy in American history. Over $600 billion in assets, 25,000 employees. And just like that, it was gone. The stock market plummeted. Panic spread. Lehman's failure triggered a chain reaction across the globe. Money market funds, thought to be the safest place to park cash, began to break the buck, meaning they could no longer guarantee even $1 per share. Short-term lending dried up. Corporations could not roll over their debt. Municipalities could not finance basic operations. Payrolls were at risk. In October, the Dow Jones Industrial Average dropped over 18% in just 8 trading days. It was not just a financial crisis anymore. It was an economic heart attack. The Treasury Department and the Federal Reserve scrambled. On October 3rd, Congress passed the Emergency Economic Stabilization Act, creating a $700 billion bailout fund, known as TARP, the Troubled Asset Relief Program. The idea was to stabilize the banks, restore confidence, and unfreeze credit markets. But confidence is a fragile thing. People began pulling their money from investment accounts. Businesses stopped hiring. Families stopped spending. Unemployment was rising. Foreclosures were everywhere. Retirement savings were vanishing. The American economy was grinding to a halt. And through it all, the question kept repeating like a heartbeat underneath the noise. How did this happen? How did so many smart people with so many models and degrees and years of experience not see it coming? Or worse, did they see it and just ignore it? In the fall of 2008, the answer did not matter much anymore. The damage was done, and all that was left was to try to stop the bleeding. The Dominoes Fall. After Lehman Brothers collapsed, it was as if someone had kicked the foundation out from under a vast, teetering tower. The markets were not just volatile, they were terrified. Every morning brought new rumors. Which bank was next? Who would fail today? No one knew. And that uncertainty was lethal. AIG, the giant insurance firm, was next in line. It had quietly built up a mountain of exposure to mortgage-backed securities through something called credit default swaps. In simple terms, AIG had sold insurance on billions of dollars of toxic assets. But when the defaults surged, the calls came due, and AIG did not have the cash. It needed a bailout. Fast. On September 16th, just one day after Lehman's collapse, the U.S. government stepped in with an $85 billion emergency loan to save AIG. Yes, $85 billion. In the same week, Merrill Lynch was sold off to Bank of America. Washington Mutual failed. It was the largest bank failure in U.S. history at the time, and Wachovia teetered before being absorbed into Wells Fargo. It was like watching dominoes fall in slow motion, except each one was a household name. The public reaction was a mix of disbelief and fury. People wanted to know, how could these massive institutions be so fragile? And why were taxpayers the ones left holding the bag? Phrases like "too big to fail" entered the national vocabulary. In boardrooms and press briefings, officials argued that letting these firms collapse would lead to economic ruin. But on Main Street, people saw CEOs keeping bonuses while workers lost homes, jobs, and savings. The anger was real, and it was growing. Meanwhile, the Federal Reserve was using every tool it had. Interest rates were slashed to nearly zero. The Fed began pumping money into the system through emergency lending facilities, but it felt like trying to patch a sinking ship with duct tape. Consumer confidence collapsed. Auto sales plummeted. Retailers closed. Construction froze. And it was not just America anymore. Europe was catching the infection. Banks in the United Kingdom, Germany, Ireland, and Iceland were in trouble. Global trade contracted. Stock markets from Tokyo to Toronto were in freefall. In October 2008, world leaders gathered in Washington to coordinate a response. The crisis had gone global, and it would take more than one central bank to fix it. But at home, Americans were not thinking about international finance. They were thinking about rent and groceries and whether their job would still be there next week. The economic engine had not just slowed, it had stalled, and no one knew how long it would take to restart it. The human cost. By late 2008, the numbers told one story, but the people told another. Unemployment was climbing, yes, but behind every percentage point was a family packing boxes, a landlord knocking on a door, a child hearing the word foreclosure for the first time. Between 2007 and 2010, over 8 million Americans lost their jobs. More than 4 million homes were foreclosed. For many, it happened almost overnight. A pink slip, a missed mortgage payment, and suddenly, the house was gone. Whole neighborhoods were gutted. In places like Las Vegas, Phoenix, and parts of Florida, rows of empty houses stood silent. Lawns grew wild. Windows were boarded up. In some streets, the only sign of life came from foreclosure notices flapping in the wind. People who had worked their whole lives were now standing in unemployment lines, searching for jobs that had vanished. Retirees watched their pensions shrink. Parents skipped meals to feed their kids. In Detroit, car plants shut down. In small towns, the local factory or mill closed, and with it went the diner, the barber shop, the dry cleaner. In cities, office buildings darkened, their tenants gone. And the psychological toll was just as deep. A sense of shame settled in. People blamed themselves. They had believed the system was stable. They had trusted their brokers, their banks, their government. They had played by the rules, and still they lost everything. For younger workers, the crash became a generational wound. College grads entered a job market that was frozen. Dreams of buying a house or starting a family were pushed years down the road. For many, they never recovered fully. Charities and food banks were overwhelmed. Shelters filled up. Families doubled up in apartments, sleeping on couches, living out of cars. Some ended up in tent cities, actual encampments that sprang up outside places like Sacramento and Seattle. Even for those who kept their jobs, the fear was constant. Would they be next? Could they hang on? Could they afford to get sick? The crisis eroded something deeper than finances. It chipped away at a sense of security, of fairness, of possibility. And through it all, Wall Street remained, still standing, still spinning. People saw bank executives testifying before Congress, defending their bonuses, claiming they had not seen it coming. It felt like a second betrayal. If the crisis had exposed anything, it was this. The system did not protect everyone equally. Some had parachutes, others had nothing. By the end of 2008, America was not just in a financial crisis. It was in a crisis of faith, in its institutions, its economy, even in the idea of the American dream. And as winter set in, there was one burning question on everyone's mind. What would Washington do next? The Bailout Debate. In September 2008, just days after Lehman Brothers collapsed, Treasury Secretary Henry Paulson walked into the halls of Congress with a plan. He asked for an unprecedented $700 billion, not in loans, not in stimulus checks, but in direct authority to buy toxic assets from banks drowning in their own bad bets. No one had ever seen anything like it. The proposal was 3 pages long. No oversight, no conditions, just a massive transfer of trust and money based on urgency and fear. Paulson said that without immediate action, the entire financial system could melt down. Credit would freeze. Businesses could not pay workers. ATMs might stop dispensing cash. The room went silent. Then came the outcry. Republicans balked at the size and scope. Democrats demanded accountability. Across the country, phones in congressional offices lit up. Voters were furious. Ordinary Americans watching their savings disappear and their homes foreclosed did not understand why the government was about to rescue the very people who had caused the collapse. On talk radio, callers raged. On cable news, pundits fumed. Protesters took to the streets. The word bailout became toxic, and yet the markets kept falling. Credit was seizing up. Banks refused to lend even to each other. Businesses could not finance payrolls. The fear was contagious. On September 29th, the House of Representatives rejected the initial bailout bill. The stock market responded by plunging 777 points, the largest single-day point drop in history at the time. The panic deepened. Behind the scenes, officials scrambled. They revised the bill, adding oversight, sprinkling in tax incentives, and giving it a new name, the Troubled Asset Relief Program, or TARP. On October 3rd, Congress passed the revised bill. President George W. Bush signed it into law that same day, but the damage was done. The public's trust had been shaken. The optics were brutal taxpayers footing the bill for Wall Street's recklessness. There were no handcuffs, no accountability, just headlines of failing firms getting rescued while families lost everything. And for all the noise, the truth was, even the experts did not know if the bailout would work. They were throwing sandbags at a rising tide, hoping something would hold. The crisis had entered a new phase, not just of economics, but of politics and public memory. And just as Washington scrambled to stop the bleeding, a new face stepped into the spotlight, one that would shape the next chapter of America's response. His name was Barack Obama. A new president, a new plan. The winter of 2009 was cold in more ways than one. Across America, layoffs mounted. Unemployment was nearing 8% and still rising. Homes were being foreclosed at a pace unseen since the Great Depression. Car sales collapsed. Factories closed. For millions, the American dream felt like a cruel memory. And then came January 20th, 2009. On the steps of the Capitol, Barack Obama took the oath of office. He was young, composed, and carried the hopes of a battered nation. The crowd stretched across the National Mall, packed in coats and scarves, cheering not just for a new president, but for a lifeline. His first priority was clear: stop the bleeding. Within weeks, the American Recovery and Reinvestment Act was on the table. It was an $831 billion stimulus package, far larger than anything proposed before. But unlike the bailout, this plan was aimed at ordinary Americans. It included tax cuts, extended unemployment benefits, infrastructure spending, aid to schools, and green energy investments. Still, the politics were brutal. Many Republicans called it wasteful. They mocked it as a pork-filled spending spree. But behind closed doors, most agreed that doing nothing would be worse. In February 2009, Congress passed the bill with minimal Republican support. Obama signed it into law on February 17th in Denver, Colorado. It was a gamble, not just economic but historical. The administration argued that without it, unemployment might hit double digits and stay there. Critics warned of exploding deficits. Americans, meanwhile, were simply tired of fear of numbers they could not understand, of watching savings vanish and jobs disappear. Obama's tone was steady, sober, and laced with cautious hope. He warned it would take time, that healing an economy was not like flipping a switch, but he also reminded the country that resilience was part of the national DNA. For the first time in months, there was a sliver of optimism. Still, recovery was not linear. Banks remained weak, credit remained tight, and the foreclosure crisis, especially in places like Nevada, California, and Florida, kept churning through neighborhoods. But the bleeding slowed, and slowly as months passed, America turned a corner. Not because things were fixed, but because they had stopped getting worse. Yet underneath the fragile calm, resentment brewed. Many Americans still saw Wall Street bonuses returning while their wages stagnated. They heard about recovery, but they did not feel it. And in that growing gap between statistics and lived experience, something began to stir. It would not be long before that anger had a name and a movement. But before that moment arrived, there was one more shock in store for the financial world, and it came from across the ocean. The European echo. In the spring of 2010, while America was just beginning to breathe again, a new crisis erupted, this time not on Wall Street, but across the Atlantic. The echo of America's financial collapse had reached Europe, and for countries like Greece, Spain, Portugal, and Ireland, it sounded like thunder. At the center of the storm was Greece. For years, Greece had borrowed heavily to fund public services, pensions, and infrastructure. But when the global economy contracted, the math stopped working. Tax revenues collapsed, debts ballooned, and in late 2009, a new Greek government revealed that the previous administration had underreported the national deficit by a lot. The real figure was closer to 13% of GDP, not the 6% they had claimed. Markets panicked. Investors dumped Greek bonds. Yields soared. And suddenly, one of the Eurozone's smaller economies looked like it might default. That scared not just banks in Europe, but American ones too. Many held European debt or had exposure through swaps and other instruments. And it was not just Greece. Portugal had a high deficit. Spain was battling unemployment over 20%. Ireland had suffered a housing crash almost as severe as America's. Italy's debt load was massive. It was not just a Greek crisis, it was a sovereign debt crisis, and the very future of the euro was at stake. In May 2010, European leaders scrambled to respond. They assembled a €110 billion bailout for Greece, led by the European Union and the International Monetary Fund. The plan required deep austerity cuts to pensions, public salaries, and tax hikes. In theory, these moves would reassure markets. In practice, they unleashed fury. Athens erupted in protests. Strikes shut down transit and services. Angry crowds filled Syntagma Square, waving signs that compared German Chancellor Angela Merkel to authoritarian figures of the past. To many Greeks, this was not rescue, it was punishment. Meanwhile, in the U.S., analysts watched with unease. American banks were deeply entwined with European financial institutions. If European banks began to wobble, the effects would ripple outward. The same fears that had haunted the U.S. in 2008 liquidity freezes. Panic-selling bank runs began to surface again. The Federal Reserve, still cautious from the last crisis, acted swiftly. In May 2010, it joined other central banks to reopen currency swap lines, allowing European banks access to dollars. It was a quiet move, one many Americans never noticed. But behind the scenes, it was critical. The global financial system remained deeply interconnected. A crisis in Athens could still shake markets in New York, Chicago, and Los Angeles. And so began the age of contagion. Economists started speaking of periphery and core Europe. The weaker economies, Greece, Portugal, Ireland, Spain, were the periphery. Germany, France, and the Netherlands formed the core. If the periphery collapsed, the entire structure could follow. To prevent that, Europe created new mechanisms. The European Financial Stability Facility, the European Stability Mechanism, the Troika, a nickname for the European Commission. The European Central Bank and the IMF took on unprecedented power, demanding reforms in exchange for aid. But austerity came at a cost. In Greece, the economy shrank year after year. By 2013, GDP had fallen by over 25%. Unemployment neared 30% youth. Unemployment soared above 60%. Suicides increased. Social services broke down. A generation was being lost. In Spain, families moved back in together. Young adults delayed marriage. Public anger brewed. New political movements like Podemos in Spain and Syriza in Greece began to rise, challenging the old order. Back in the U.S., the Obama administration observed this with mixed emotions. On one hand, it validated their choice not to impose austerity during the downturn. On the other, it highlighted how fragile global recovery remained. American exports to Europe slowed. Markets jittered with each headline from Brussels or Athens. And many feared that the next phase of the crisis might not be financial, it might be political. Because when economies break, politics shifts, populism rises, trust fades, people seek someone to blame, and whether in Europe or America, the seeds of resentment had been planted. In America, they would soon bloom in ways no one quite predicted. But in that moment, the headlines were still overseas. Greece, Spain, Italy. Words that once conjured images of vacations or ancient ruins now brought to mind bond yields and bailout packages. The crisis had crossed oceans. It had changed languages. But its core remained the same. A system built on debt risk and optimism had cracked, and the aftershocks were still coming. Dodd-Frank and the rules of the game. By mid-2010, the fires had been partially contained. The economy was no longer in free fall. Banks had stabilized. The stock market had recovered much of its losses and job growth, while fragile was slowly returning. But beneath the surface, one question still haunted Washington, Wall Street, and Main Street alike. How do we stop this from ever happening again? That summer, after months of bitter debate, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. It was one of the most sweeping overhauls of the American financial system since the Great Depression. Its name came from its two main architects, Senator Chris Dodd of Connecticut, and Representative Barney Frank of Massachusetts. But what the bill tried to do was much bigger than any one name. It aimed to rewrite the rules of the game. First, it created a new watchdog, the Consumer Financial Protection Bureau, or CFPB. This agency was designed to protect ordinary Americans from the kinds of predatory practices that had flourished in the years before the crash: hidden fees, tricky loan terms, and fine print that no one could understand. For the first time, payday lenders, mortgage brokers, and even student loan companies would face serious scrutiny. Second, the law tried to rein in the biggest banks. Before 2008, some institutions had grown so large, so complex, that their collapse could take down the entire system. The phrase "too big to fail" had become a kind of curse. So Dodd-Frank introduced new capital requirements. It forced big banks to keep more money on hand as a buffer. It also created the Financial Stability Oversight Council, a team of regulators charged with identifying risks before they exploded. Third, it cracked down on exotic financial products. Remember those credit default swaps and synthetic collateralized debt obligations? The stuff that even Wall Street insiders struggled to explain. Dodd-Frank brought much of that shadowy world into the light. Derivatives had to be traded on public exchanges. Transactions needed to be reported. The days of secret deals in back rooms were supposed to be over. But perhaps the most emotional debates centered on a single phrase: the Volcker Rule. Named after former Federal Reserve Chairman Paul Volcker, this rule tried to separate what banks could do with your money. Under the new law, banks could no longer use customer deposits to make risky bets for their own profit. In essence, it was a modern twist on Glass-Steagall, the Depression-era law that once kept commercial and investment banking apart. Supporters said it was common sense. Opponents cried foul. Wall Street lobbied hard. Some claimed the rule would hurt liquidity, make markets less efficient, and reduce credit availability. Others said it didn't go far enough. Still, the bill passed. President Obama signed Dodd-Frank into law on July 21, 2010. The ceremony was modest, but the symbolism was not. A pen stroke, a smile, and the promise that never again would America be brought to its knees by reckless finance. But in practice, the law was just the beginning. Regulators still had to write hundreds of rules to bring the law to life. Lobbyists flooded Washington trying to water down key provisions. Banks hired armies of lawyers. The CFPB, though powerful on paper, became a political lightning rod. Its first director, Elizabeth Warren, faced resistance before she could even take office. Eventually, she moved on to run for Senate. Meanwhile, many Americans remained skeptical. They had seen the bailouts. They had watched Wall Street rebound, while their own homes lost value. To them, Dodd-Frank was either too late, too weak, or too complicated. Few people understood what the law actually said. Fewer still believed it would change anything. Yet behind the scenes, it did matter. Banks changed their models. Risk officers gained clout. Stress tests became routine. The Federal Reserve gained new powers to monitor systemic risk. And perhaps most important of all, regulators now had a playbook for future crises. But here's the thing about financial reform. It is like flood insurance. No one appreciates it until the storm comes. And by then, it is usually too late. In the years that followed, some provisions of Dodd-Frank were quietly weakened. In 2018, under President Trump, a rollback bill loosened rules for mid-size banks. Critics warned this could open the door to new risks. Supporters claimed it would help community lenders. The truth, as always, was somewhere in between. Financial regulation is not a finish line. It is a constant tug-of-war between innovation and stability, between risk and reward, between profit and responsibility. And in 2010, Dodd-Frank was the best shot America had. It did not fix everything. It did not please everyone. But it was a signal, however imperfect, that the era of anything goes finance was over. Or at least, that was the hope. Main Street Blues. By 2011, the stock market had bounced back. The banks were alive. The big corporations were hiring again. Wall Street bonuses were flowing, and the talking heads on cable news were saying the worst was over. But if you were not one of the lucky few, none of that mattered. Across America, the mood on Main Street was very different from the one on Wall Street. You could feel it in the quiet grocery store lines, in the help-wanted signs that never came down, in the hollowed-out malls where teenagers once killed time, and in the hushed tones of neighbors who were still behind on their mortgages. Millions of people had lost jobs, and many of those jobs never came back. The factories that closed in Michigan and Ohio stayed closed. The construction sites in Nevada and Florida remained frozen. Middle-aged workers who once had steady union gigs now found themselves applying for part-time retail jobs, competing with college kids for minimum wage. And then there were the homes. By 2011, over 4 million homes had been foreclosed. Some neighborhoods in cities like Las Vegas, Phoenix, and Detroit looked like ghost towns. Streets where every third house was abandoned, lawns overgrown, mailboxes stuffed, windows boarded up. It was not just an economic collapse. It was a collapse of community. People stopped trusting. They stopped trusting the banks, the government, the media, and sometimes even each other. For many, it felt like the rules had changed without warning. You could work hard, save money, raise a family, and still lose everything. And that anger simmered. You heard it in the diner booths and church basements. You saw it in the protest signs. People began to ask hard questions. Why did the banks get saved but not us? Why were executives getting bonuses while teachers were getting laid off? Why did no one go to jail? In September 2011, that anger found a home in Zuccotti Park, a small public space in Lower Manhattan, just steps away from the beating heart of American finance. They called it Occupy Wall Street. At first, it was small, a few dozen people with backpacks, sleeping bags, and cardboard signs. But it grew quickly. Fueled by social media and a sense of injustice, the movement captured a mood that had been brewing for years. "We are the 99%, became the rallying cry. The message was simple. The system is rigged. They spoke of wealth, inequality, corporate greed, student debt, climate change, and a political system bought and sold by lobbyists. It was messy. It was loud. There were no clear leaders, no policy agenda. But it struck a nerve. Soon, Occupy camps were popping up in cities across the country. San Francisco, Boston, Chicago, Seattle. Tents and tarps filled parks. Protesters debated economics over donated pizza. Drummers played all night. Local officials tried to figure out what to do. Some mayors allowed the camps to stay. Others sent in the police. By late 2011, most of the camps had been dismantled. But the movement left a mark. It changed the conversation. For the first time in decades, income inequality became a mainstream political issue. Politicians started talking about the shrinking middle class, the minimum wage, and student debt with a new sense of urgency. Even though Occupy faded, its ghost lingered in every town hall, every debate stage, every headline that spoke of billionaires and food stamps in the same breath. Meanwhile, the wounds from the recession were healing, but slowly and unevenly. For younger Americans especially, those graduating during the crisis, the scars were deep. They were called the lost generation, a cohort saddled with debt entering a job market that did not want them, and forced to delay milestones, like buying a home, starting a family, or saving for retirement. For older workers, the damage was often permanent. Laid off at 55, they faced a brutal reality, starting over with no safety net. Some drained their 401ks. Others took Social Security early, locking in lower payments for life. The middle class, once the pride of American stability, felt hollowed out. By 2013, the technical indicators said the recession was over. GDP was growing again. The unemployment rate had dipped below 8%. But for millions, that recovery never felt real. It was like being told the fire was out while you were still standing in the ashes. And this discontent began to seep into politics. You could hear it in the Tea Party rallies. You could see it in the rise of new voices on both the left and right, people who rejected the old rules, who spoke with rage or urgency, or both. America was no longer just divided by partisanship. It was divided by experience. Some had bounced back. Others never would. And the distance between them would define the next decade. But for now, in the early 2010s, the country stood in a strange twilight. The danger had passed, but the pain remained. Wall Street had been rescued. Main Street was still waiting. And in the silence between them, something was building something that would erupt in the years to come. The global fallout. While America wrestled with its wounds, the rest of the world was still trying to catch its breath, because the financial crisis of 2008 was not just an American story. It was global. And by 2010, its aftershocks were rattling parliaments, collapsing economies, and stirring anger in places most Americans rarely thought about. Take Europe, for example. In the early days of the crisis, European leaders had watched Wall Street's meltdown with a mix of alarm and smugness. The message was clear. This was America's mess. But that comfort did not last long, because many European banks had also bought the same toxic mortgage assets that wrecked the U.S. system, and they had taken even bigger risks in secret. The first signs of trouble came in Iceland, of all places, a tiny island nation with fewer people than most American suburbs. Iceland had tried to become a global banking hub in the early 2000s. Its banks grew 10 times the size of its economy, and when the crisis hit, they imploded. By late 2008, Iceland's entire banking system collapsed. The country had to borrow money from the International Monetary Fund, Britain, and the European Union to survive. It was a preview of what was coming. Soon, the crisis moved south to Greece. Greece had been hiding its debt for years. Using creative accounting, the government had masked the true size of its deficit to meet the requirements of the Eurozone. But by late 2009, the truth spilled out. Greece was deeply in debt, unable to pay its bills, and markets panicked. The Greek debt crisis became the epicenter of Europe's version of 2008. Protesters filled the streets of Athens. Pensioners marched beside students. Public workers went on strike. Riots broke out. Molotov cocktails were thrown. People felt betrayed, not just by their government, but by a system that seemed rigged against them. To avoid default, Greece had to accept a harsh bailout deal from the International Monetary Fund and the European Central Bank. The price, severe austerity. That meant deep cuts to public spending, higher taxes, and slashed pensions. It was economic triage, and it hurt. The crisis spread like wildfire. Ireland teetered next, then Portugal, then Spain. Each country had its own version of the problem. Some had banking collapses, others had housing bubbles, and many had bloated deficits. But the story was the same: economies, shrinking, unemployment rising, and public anger exploding. In Spain, youth unemployment topped 50%. In Portugal, government salaries were frozen and benefits cut. Even in Italy, one of Europe's largest economies, debt fears triggered political turmoil and market shocks. The continent became consumed with one question: would the euro survive? Remember, The euro was more than a currency. It was a symbol of European unity, a shared coin for nations that had once gone to war with each other. But now that unity was fracturing, stronger economies like Germany resented bailing out weaker ones. Weaker economies felt strangled by Germany's demands. Tensions rose between North and South, rich and poor, creditor and debtor. Meanwhile, across the ocean, China was feeling the tremors too. Its economy had been booming for years, fueled by exports to the United States and Europe. But when the West stopped buying, Chinese factories sat idle. Tens of millions of migrant workers lost their jobs. The Chinese government responded with one of the largest stimulus packages in history, over $500 billion, mostly spent on infrastructure. That decision helped keep China growing, but it also sowed the seeds of future problems: inflated housing markets, shadow banking, and vast local government debt. In developing countries, the crisis meant something else entirely. Global trade shrank. Commodity prices collapsed. Foreign investment dried up. For countries like Brazil, South Africa, and India, that meant slower growth and rising poverty. In some places, political instability followed. In others, new movements emerged, demanding a break from neoliberal economics. In other words, this was not just a financial crisis. It was a global reset. And through it all, one country watched carefully: Russia. Vladimir Putin, back in power behind the scenes, saw an opportunity. While the West was distracted, divided, and angry, Russia could reassert itself. And in the coming years, it would in Crimea, in Syria, and through cyber means we had yet to understand. Back in the United States, policymakers began to realize something profound. The crisis had not only wrecked markets, it had shaken the foundations of the post-Cold War world, the belief that open markets and global trade would lift all boats, that deregulation and free flows of capital would bring peace and prosperity. That dream was now in doubt. Around the world, people were turning inward. Nationalist movements gained strength. Populist leaders began to rise. Global institutions, the EU, the WTO, the IMF, came under fire. The very idea of globalization felt tarnished. And so, in a strange twist, the crisis that began with American mortgages ended up reshaping the entire world order. From Athens to Beijing, from Dublin to São Paulo, the aftershocks continued. But perhaps the most surprising effect was still to come. Because while economists debated interest rates and trade balances, a different kind of upheaval was stirring. One rooted not in numbers, but in stories. The narrative shift. By 2011, the headlines were still about debt ceilings, austerity, and sluggish recoveries. But under the surface, something deeper was happening. The numbers had begun to stabilize. Markets had calmed. Banks were no longer on the brink. But the people were not okay. They had lost more than jobs and homes. They had lost trust. Trust in banks. Trust in politicians. Trust in the very idea that the system was fair. It started showing up in small ways. A drop in voter turnout. A spike in protests. Late-night comedians cracking sharper jokes. Then came something no one quite expected. Occupy Wall Street. It began in September 2011 when a small group of activists gathered in Zuccotti Park, a concrete square tucked between skyscrapers in Lower Manhattan. They were not bankers or economists. Most were young, some were artists. Others recent grads buried in student loans. They brought signs, sleeping bags, and one powerful message: we are the 99%. That phrase exploded across social media. It captured what data had been showing for years, that nearly all the gains from the economic recovery were going to the wealthiest slice of society. That Wall Street bonuses were back, while middle-class wages were stuck. that executives were buying new yachts while workers were skipping doctor visits. Occupy was messy. It had no clear demands, no official leader. But it tapped into a mood, a gnawing sense that the game was rigged. Within weeks, similar encampments popped up in cities across America: Boston, Los Angeles, Chicago. Even abroad in London, Berlin, Madrid. It was not just about bailouts anymore. It was about inequality, about how a system supposedly built on merit had rewarded recklessness, about how millions of ordinary Americans had played by the rules, worked hard, paid taxes, saved for retirement, and still lost everything while those at the top had walked away richer. The movement drew criticism. Some called it naive, others chaotic. City officials faced with hygiene issues and public pressure eventually cleared most of the camps. But the message stuck. The language of inequality re-entered politics. Senators started quoting the 99% in speeches. Economists wrote op-eds about wage stagnation and mobility. Even the Federal Reserve began talking about how inequality could hurt growth. Something had shifted. Meanwhile, another narrative began taking hold, one that was far more cynical. If Occupy was born from disappointment, the Tea Party was born from anger. It had started earlier in 2009 as a backlash to the bailouts and President Obama's stimulus plan. But by 2010 and 2011, it had grown into a potent political force. Tea Party candidates won seats in Congress. They called for smaller government, lower taxes, and stricter constitutional adherence. But underneath the slogans was a deep mistrust of Washington, of elites, of institutions that once held the country together. This was not just left versus right. It was frustration versus control. Both Occupy and the Tea Party were symptoms of the same illness, a belief that the system no longer served ordinary people, that whether you were a truck driver in Ohio or a barista in Brooklyn, the odds were stacked. As the 2012 election approached, these dueling narratives shaped everything. Barack Obama ran for re-election on a platform of rebuilding the middle class. He talked about fairness, taxing the wealthy, and protecting Medicare. His opponent, Mitt Romney, pitched a business-savvy vision of recovery, arguing that Obama's policies had slowed growth. But a secret recording from a private fundraiser would haunt him. In the tape, Romney was heard saying that 47% of Americans were dependent on government and would never vote for him. It confirmed for many the suspicion that the wealthy saw the rest of the country with disdain. Obama won re-election. But the divisions were sharper than ever. The Great Recession had ended on paper. The stock market had recovered. Corporate profits were booming. But for many Americans, life still felt fragile. Wages were flat. Healthcare costs kept rising. The cost of college was exploding. Entire towns still had not recovered. And young people entering the job market carried not only student debt, but the trauma of watching their parents lose jobs and dignity. Trust once lost is hard to regain. The crisis had planted a seed of doubt, a sense that maybe hard work did not guarantee security, that maybe institutions were not neutral, that maybe, just maybe, the dream itself had cracked. People started to ask bigger questions. Why had no top banker gone to jail? Why were homes still underwater while bank stocks soared? Why did the same people who warned of moral hazard for homeowners never mention it for hedge funds? The answers were complicated, but the anger was simple. By 2013, the economy was growing again. But the story had changed. This was no longer just about a financial crisis. It was about a crisis of meaning. And that kind of crisis, quiet, personal, widespread, tends to linger. Long after the charts turn upward, long after the experts declare recovery, the people remember. They remember the empty houses, the pink slips, the canceled weddings, the sleepless nights. They remember how it felt to be scared and alone and unheard. And those memories left unchecked often find their way into movements, into votes, into futures. A generation shaped by crisis. By the time the stock market had returned to its pre-crisis levels in 2013, something had quietly shifted, not just in the economy, but in an entire generation's worldview. These were the millennials, the so-called generation of participation trophies, though none of them had asked for those trophies in the first place. They had come of age watching their parents lose jobs, homes, and retirement savings. They graduated into the worst job market in decades, saddled with record levels of student debt, and were told, often unhelpfully, to just work harder or move back in with your parents for a bit. For many, that was not a short-term solution. It became their 20s. The data told a clear story. Homeownership among people under 35 plummeted. Marriage rates declined. Birth rates dropped. Young people were delaying everything, buying homes, starting families, even owning cars. Not because they were lazy or selfish or addicted to phones, but because they could not afford the life they were promised. The traditional path, go to college, get a job, buy a home, start a family, no longer felt like a guarantee. It felt like a gamble. And in a world still healing from financial trauma, fewer were willing to roll the dice. So they adapted. They moved into cities, rented apartments with roommates well into their 30s, and took gig jobs to stay afloat. They got creative, freelanced, started side hustles, and learned how to navigate a world where benefits like health insurance and retirement plans were no longer a given. And many of them became deeply skeptical of the system. They saw banks get bailed out, while student loan interest piled up. They watched Wall Street celebrate billion-dollar earnings, while entry-level salaries stagnated. They did not want revenge, but they did want answers. And what they got instead were talking points. So they turned elsewhere, toward grassroots politics, digital activism, and voices that promised something different. They followed figures who said out loud what many had felt for years, that the economy was not broken, it was rigged. It was not just economic, it was cultural. Millennials began redefining success. They valued experiences over possessions, community over hierarchy, flexibility over corner offices. They were not trying to kill industries like cable TV shopping malls or casual dining chains. They simply could not afford them. They were not unambitious. They were just unconvinced that ambition would protect them next time the system cracked. And then, just as some stability returned, came another shift. Technology had been quietly reshaping the job market, but now it was accelerating. Automation, artificial intelligence, and e-commerce transformed industries almost overnight. Some called it progress. Others called it disruption. But to many workers it felt like displacement. The factory jobs were already gone. Now the retail jobs, the customer service roles, even parts of white-collar work began to feel unstable. The rules of employment had changed, but the safety nets had not. In this context, a new political vocabulary began to emerge. Terms like universal basic income, democratic socialism, and wealth tax moved from the academic fringe into mainstream conversation. Politicians like Bernie Sanders and Elizabeth Warren gained passionate followings, not because their ideas were new, but because their message resonated with the post-crisis generation. It was not about nostalgia. It was about fairness. About the idea that in the richest country in the world, people should not have to choose between insulin and rent. That working full-time should not leave you in poverty. That higher education should not come with a lifelong financial penalty. These ideas were divisive, of course. Many Americans still believed in free markets and individual responsibility. But even among conservatives, the notion that something was deeply off had taken root. Meanwhile, the next generation, Gen Z, was entering adulthood. They had grown up in the shadow of the crisis. Their first memories of the economy were of fear and fragility. They had watched their parents struggle, seen the cost of college skyrocket, and come of age in an era of climate anxiety, school shootings, and political chaos. And yet somehow they were more optimistic, more diverse, more connected, more vocal. They had watched the system stumble. They were determined not to make the same mistakes. The Great Recession, as it would eventually be called in textbooks, was not just a financial event. It was a generational rupture, a before and after line in the American psyche. Before a belief in upward mobility, in the American dream as a kind of economic gravity. After a new awareness that gravity sometimes fails, that safety nets fray, that no one is coming to save you, but also perhaps a new resolve, not to return to the old normal, but to build something better. In boardrooms and ballot boxes, in tweets and protests, the echoes of the crisis lived on, not as nostalgia, not as bitterness, but as memory, as fuel. Because when a generation grows up with fire at its feet, it does not forget the burn. And while the ashes may settle, the questions remain. Who is the economy for? What is wealth if not shared? What do we owe one another after the fall? These are not academic questions. They are the legacy of 2008, and they will shape what comes next. Wall Street's Redemption Arc by 2014. Something unexpected was happening on Wall Street. The very institutions that had nearly brought the global economy to its knees were thriving. Stock markets were climbing to record highs. Bank profits were back bigger than ever. Bonuses flowed again, this time with less champagne in public, but the numbers told the story. In just a few years, America's largest banks had gone from bailout recipients to billion-dollar beasts. J.P. Morgan Chase, Goldman Sachs, Bank of America, Citigroup, Morgan Stanley. Their logos had survived the public anger, the congressional grillings, the editorial takedowns. And now they were growing again, not just in size, but in confidence. How part of the answer was technical. After the crisis, regulators around the world imposed new rules. In the United States, the Dodd-Frank Act of 2010 introduced stress tests, capital requirements, and the Volcker Rule, which aimed to prevent banks from making risky bets with depositor money. These rules were meant to curb excess and increase transparency. But Wall Street adapted. They hired compliance teams, built algorithms to navigate regulations, found loopholes, lobbied hard. Between 2008 and 2016, the financial industry spent hundreds of millions of dollars on lobbying and campaign donations, slowly chipping away at the restrictions. And they got results. By the mid-2010s, some of the Dodd-Frank rules were softened. Enforcement slowed. The Consumer Financial Protection Bureau, once a feared watchdog, faced funding cuts and leadership changes. Wall Street did what it always does best. It adjusted. Meanwhile, the American public was distracted. After years of economic anxiety, people were tired. The technicalities of bank capitalization ratios and derivatives reform were hard to follow. The news cycle had shifted to healthcare battles, foreign policy celebrity scandals, and the 2016 election. In that vacuum, Wall Street rebranded. They invested in tech, embraced fintech startups, built sleek apps with pastel logos and friendly interfaces. Banking became mobile, frictionless, almost fun. People could buy stocks from their phones, open savings accounts in under 5 minutes, or borrow money with a few taps. To many young consumers, banks no longer looked like villains. They looked like convenience. But under the surface, the old dynamics remained. Risk never disappeared. It just changed shape. Instead of mortgage-backed securities, the new craze was exchange-traded funds, quantitative strategies, crypto derivatives, and private equity takeovers. Markets were driven by algorithms and global capital flows. Complexity returned, dressed in newer clothes. Some called it innovation, others called it déjà vu. And then came Donald Trump. Elected in 2016, Trump promised to tear down regulations that, in his words, were choking the economy. His administration rolled back several provisions of Dodd-Frank, loosened oversight on mid-sized banks, and appointed industry-friendly figures to key regulatory positions. Wall Street cheered. Stocks soared. In 2018, Congress passed a law that exempted many banks under $250 billion in assets from the strictest oversight. It was a quiet but crucial moment. The guardrails set up after 2008 were not removed entirely, but they were thinned. Meanwhile, Americans were told the economy was booming, and by many metrics it was. Unemployment reached record lows. GDP growth was steady. Corporate profits surged. But beneath the surface, inequality had deepened. The top 10% of Americans held nearly 70% of all wealth. Wages for the bottom half had barely moved, and household debt was once again rising. Student loans, car loans, credit cards. For Wall Street, the crisis had become a memory. For Main Street, the recovery still felt uneven. Yet the banks had a new story to tell. They were no longer just profit machines. They were philanthropists. J.P. Morgan's Jamie Dimon talked about inclusive capitalism. Goldman Sachs launched initiatives for small businesses. CEOs appeared at climate summits and diversity panels. Finance had discovered corporate social responsibility. Skeptics rolled their eyes. But for a new generation of bankers, many of whom had entered the industry post-crisis, the narrative worked. They genuinely believed they were fixing things, making finance more ethical, more transparent, more human. Maybe that was true, or maybe it was just good branding. Still, the mood on Wall Street in the late 2010s was confident. The system had bent, but not broken. Bailouts had been paid back with interest. Regulation had been absorbed. The public had moved on. And the economy, despite its cracks, kept humming. Until once again it didn't. Because in early 2020, a different kind of shock arrived. It wasn't a subprime mortgage. It wasn't a trading algorithm gone rogue. It was a virus. And this time the threat wasn't hidden in financial statements. It was in the air we breathed. Pandemic shock. The markets were humming along in early 2020. Stocks were at record highs. Unemployment was at record lows. Corporate profits were robust. Bankers were sipping oat milk lattes while tracking investment portfolios on their phones. And politicians were touting the best economy ever. And then suddenly, the world caught a cold. In late January, most Americans had barely heard of Wuhan. By February, it was a headline. By early March, it was everywhere. COVID-19 moved fast. Within weeks, cities emptied, airports went silent, storefronts shuttered, Broadway went dark. A silent panic spread faster than the virus itself, and Wall Street panicked too. In a matter of days, the stock market plummeted. Between February 20th and March 23rd, the S&P 500 lost 34% of its value. Oil prices collapsed. Treasury yields hit record lows. Investors ran for cover. It was the worst single-month drop since the Great Depression. This was not just a blip. It felt like free fall. Every major index was flashing red. Corporate credit froze. Municipal bond markets buckled. Even safe haven assets like gold wobbled. The financial system was holding on, but only just. And for millions of Americans, déjà vu returned like a punch to the gut. Unemployment claims skyrocketed. In the week ending March 21st, a record 3.3 million people filed for benefits. That number doubled the week after. Restaurants, hotels, airlines, entire industries ground to a halt. Overnight, the phrase essential worker became part of the national vocabulary. And just like that, the strong economy vanished into fog. But this time, the response came faster. Unlike in 2008, there was no hesitation. The Federal Reserve acted decisively. On March 15th, it slashed interest rates to zero. Then it opened the fire hose, buying corporate bonds, municipal debt, even junk bonds to prevent collapse. In a matter of weeks, the Fed expanded its balance sheet by trillions. And then came Congress. On March 27th, lawmakers passed the CARES Act, a $2.2 trillion stimulus package, the largest in U.S. history at the time. It sent direct checks to Americans, boosted unemployment benefits, created small business loans, and established the Paycheck Protection Program to keep payrolls going. Suddenly, Americans were getting government money deposited straight into their accounts. And markets stabilized. Stocks rebounded. Investors saw light at the end of the tunnel. But that light was uneven. While Wall Street recovered quickly, Main Street still reeled. The pandemic was not just an economic crisis, it was a mirror. It showed who could work from home and who could not, who had health care and who did not, who had savings and who was living paycheck to paycheck. And just as in 2008, inequality was laid bare again. Yet the irony was hard to ignore. As the death toll rose and small businesses folded, the stock market soared. By August 2020, the S&P 500 had fully recovered. By the end of the year, it had hit new highs. Tech companies flourished. Zoom became a verb. Amazon posted record profits. And Wall Street bonuses were back. To many, it felt surreal. People were lining up at food banks while billionaires added hundreds of billions to their net worth. The contrast was jarring, even cruel. It raised old questions with new urgency. Why does the market boom when people suffer? Who does the economy really serve? And just like that, the ghosts of 2008 were back wearing masks this time. But this crisis had a different emotional texture. It wasn't caused by financial greed, at least not directly. There was no villain in a suit, no toxic mortgage bonds to blame. Just a virus, a silent, invisible thing that reshaped life. And maybe that is why it hurt, in a different way. Because it reminded people that the system they relied on could break through no fault of their own, that the line between security and disaster was thinner than anyone had realized, and that even after years of recovery, one global shock could bring it all crashing down. Still, 2020 ended with something resembling hope. Vaccines arrived slowly at first, then in waves. Relief packages were extended. The Biden administration took office in January 2021, promising stability and science. The Fed kept rates low. Congress kept spending. And the recovery began again. But the scars were real. Businesses closed for good. Children lost critical years of education. Mental health worsened. Trust in institutions eroded. And the gap between the financial elite and the working class stretched wider than ever. By the spring of 2021, markets were euphoric. But regular people were cautious. They had seen this before, seen recovery on paper, but not in their paychecks. Seen executives celebrate while their neighbors searched for work. And so the pandemic crisis became a second act to 2008, a new layer on the old wound. But unlike 2008 this time, people began to question more deeply. Not just what had happened, but why it keeps happening, and what it says about the American economy itself. The crypto craze and meme madness. After the chaos of 2020, something strange happened. Americans stuck at home and flush with stimulus checks turned their eyes to something new, or rather something old, wearing new clothes. The stock market became a game. People who had never bought a single share in their lives were now trading from apps on their phones. The barriers were gone. No more brokers in suits. No more jargon. Just tap swipe buy. At the center of this was Robinhood, a trading app with a slick interface and zero commissions. It felt like a video game. Green arrows, confetti, instant feedback. It made investing feel fun. And then came GameStop. It started as a joke. A failing brick-and-mortar video game store with no future. Hedge funds were shorting it heavily, betting it would collapse. But a ragtag group of retail traders on Reddit, specifically a forum called ARR Wall Street Bets, had other ideas. They saw it as a chance to flip the script, to punish the billionaires, to turn the market into a battlefield. In January 2021, the price of GameStop surged from under $20 to nearly $500. It was not just a trade. It was a movement. People called it a short squeeze. But really, it was a digital riot, a middle finger to the system. Hedge funds lost billions. Robinhood froze trading, which sparked outrage. Lawmakers held hearings. Twitter exploded. Everyone had an opinion. But underneath the memes and diamond hands, something real was happening. Americans no longer trusted Wall Street to play fair. They had watched banks get bailed out, executives get bonuses, and now, when the little guys tried to win, someone pulled the plug. It was not just GameStop. It was AMC, Bed Bath & Beyond, Dogecoin, and more. Meme stocks and joke coins surged. People bought in, not because they believed in fundamentals, but because they believed in each other. Or maybe because they just wanted to believe in something. And then there was crypto. Bitcoin had existed since 2009, born in the shadow of the last financial crisis. But it was in 2021 that it went mainstream. Elon Musk tweeted. Tesla invested. Bitcoin soared past $60,000. Ethereum, Solana, NFTs, they all joined the frenzy. Crypto became a lifestyle, a culture, a rebellion. It promised freedom from banks, from inflation, from gatekeepers. No more middlemen. Just you and your digital wallet. And for a while, it worked, at least on paper. People became millionaires overnight. Celebrities launched tokens. Super Bowl ads featured talking animals promising financial revolution. It felt like a new era. But deep down, the patterns were familiar. Speculation, hype, overconfidence, and then, correction. By late 2021, cracks appeared. Scams emerged, projects failed, some coins collapsed, the NFT market cooled. And in 2022, the crypto world was rocked by something bigger. FTX, a massive cryptocurrency exchange run by a curly-haired wunderkind named Sam Bankman-Fried. He was the poster child of crypto's bright future, until he wasn't. In November 2022, FTX imploded. Billions vanished. Allegations of fraud surfaced. Regulators moved in. And just like that, crypto had its Lehman Brothers moment. People were stunned. Once again, they had believed in something: technology, transparency, decentralization, and once again, it had collapsed under human greed and mismanagement. It felt like 2008 in miniature. The system was different, but the story was the same. And in the middle of it all, Americans were still trying to rebuild. Inflation was climbing. Housing was unaffordable. Wages lagged behind. And while some rode meme stocks and crypto waves to short-lived riches, most were still struggling to afford eggs. Yet something had shifted. People were no longer afraid to question how things worked. They saw the cracks. They saw that the line between joke and reality was thinner than they thought. That markets were not always rational. That the American economy, for all its power, was still driven by confidence, perception, and sometimes pure chaos. By 2023, regulation tightened. The Fed raised interest rates to combat inflation. Crypto cooled. Meme stocks faded. Robin Hood lost its shine. But the spirit of rebellion, that hunger to level the playing field to find opportunity outside the old system, it remained. Because after 2 decades marked by crashes, bailouts, bubbles, and pandemics, Americans had learned something no textbook ever taught them. Markets are not just numbers. They are people. Fickle, hopeful, scared, greedy people. And in that chaotic swirl of emotion and data, there was always risk, and always a story waiting to be told. Rebuilding trust in the system. By the time 2023 rolled around, it felt like America had aged a decade in 3 years. The pandemic was no longer front-page news, but its fingerprints were everywhere. Prices were up. Trust was down. The financial World Bank's crypto Wall Street had all taken a hit, and the average American was left wondering, who do we trust? Now the Federal Reserve had spent 2022 and 2023 raising interest rates aggressively to battle the highest inflation in 4 decades. It worked somewhat. Inflation cooled from over 9% down to manageable levels. But the medicine came with side effects. Mortgages became more expensive. Credit card debt climbed. Job growth slowed. And yet, compared to 2008, the system held. Banks wobbled but did not collapse. The government acted faster. Regulations tightened after the Great Recession had prevented the worst-case scenarios. When Silicon Valley Bank failed in early 2023, yes, another bank, the panic was intense but contained. The FDIC stepped in quickly. Depositors were protected. The contagion stopped. It was not perfect, but it was better. Trust, though, that was harder to rebuild. Americans had seen too much. The 2008 crash, the bailouts, the pandemic, the meme stock roller coaster, the crypto frauds. They had learned again and again that institutions were only as strong as the people running them, and those people were not always honest. So rebuilding trust meant more than just fixing policy. It meant changing culture. In Washington, lawmakers debated reforms, tighter regulations for crypto, more oversight of tech-driven finance, greater transparency in private equity and hedge funds. Some bills passed. Many stalled. Lobbyists got to work. But outside the Capitol, something more subtle was happening. People were rethinking their relationship with money. You saw it in Gen Z, many of whom had entered adulthood in a world of constant crisis. They questioned the idea of homeownership. They distrusted the stock market. They cared more about financial independence than chasing corporate careers. They used budgeting apps, tracked side hustles, learned about index funds on TikTok. In the workplace, a quiet revolution was brewing. The so-called Great Resignation of 2021 had morphed into a broader conversation about work-life balance, burnout, and the meaning of success. Employers were forced to listen. Flexible hours, remote options, mental health benefits, they became competitive advantages. And then there was the rise of financial literacy as a cultural force. What used to be boring compound interest Roth IRAs, emergency funds was now content. Influencers, educators, and everyday people shared their journeys online. It was not always accurate. Some advice was terrible. But the intent was there. People wanted to understand. They wanted to take control. It was in its own way a kind of grassroots reform. Because after decades of being told, leave it to the experts, Americans had seen what the experts could do. Sometimes they fixed things. Sometimes they made them worse. And so people began to ask questions, to learn, to teach each other. Trust was not rebuilt by speeches or stimulus. It was rebuilt by conversations. Still, not everyone had the same experience. Racial and economic inequalities persisted. Wealth gaps widened. Access to financial tools and education remained uneven. And for many, the system still felt rigged. But even there, change stirred. Banks began offering more transparent products. Credit scores were re-examined. Payday lending faced scrutiny. Nonprofits and community groups pushed for inclusive finance. It was slow and often frustrating, but it was progress. And perhaps most importantly, there was a sense, fragile but real, that the next crisis might not be met with denial. People had memories now, hard-won ones. They remembered what it looked like when no one was watching the housing market, when banks bet the farm, when politicians froze, when experts shrugged. They had seen what happened when trust broke, and they had also seen what it took to build it back. It was not about perfection. It was about humility, accountability, the willingness to say we messed up and mean it. That was not easy in a country addicted to image speed and certainty. But after everything, after bubbles and bankruptcies, after rallies and riots, it felt like maybe America was learning. Not fast, not evenly, not without pain, but learning. And somewhere in that learning, trust could take root again. Not in the flashy promises of the next big thing, but in the quiet knowledge that we could do better, that we had to, and that the story of the American economy was not over yet. Lessons etched in memory. I remember walking past an old strip mall sometime in 2010. Half the storefronts were empty. The rest were clinging on an old barber shop, a dusty pawn shop, and a diner that stopped serving pie because no one had the stomach for dessert anymore. That's what the waitress said. She smiled when she said it, but you could tell it wasn't a joke. Those images never really leave you. Even now, when I drive through towns and see the skeletons of abandoned construction sites or shuttered banks, I think of the crash. Not because we are still in it, but because once you've lived through something like 2008, it becomes part of how you see the world. You grow cautious. You double-check what's too good to be true. You notice the tone of the news anchors when they talk about the market. You pay attention when a company seems to grow faster than logic allows, because you've seen what happens when people stop paying attention. The Great Recession did not just shake the economy. It changed how Americans thought about money, about risk, about fairness. And some lessons stuck harder than others. First, we learned that financial systems are fragile. For all their size, the global banks, insurance giants, and investment firms were not made of steel. They were made of contracts, confidence, and assumptions. Once enough people stopped believing in the story, the whole structure wobbled. Second, we saw how deeply connected everything is. A family in Cleveland missing a mortgage payment somehow affected a pensioner in Sweden. A falling housing market in Nevada could rock the credit ratings of a German bank. Finance had no borders anymore. That was both the miracle and the curse. We also learned that greed wears a suit. It was easy to imagine villains in capes and masks. But the real damage came from boardrooms, not back alleys. From men in pressed shirts using words like synergy and securitization. They were not all evil, but many were reckless, and almost none of them paid the price. That one left a scar. Because while Wall Street got bailouts, ordinary people got pink slips. And while executives cashed bonuses, families packed moving boxes in the middle of the night, hoping the neighbors would not notice the foreclosure sign. So we also learned about resentment. It bubbled quietly for years. You could hear it in diner booths and union halls. You could see it on message boards and late-night talk shows. People were angry, not just at the banks, but at a system that seemed rigged, a government that felt distant, an economy that recovered on paper but left them behind. That anger eventually spilled into politics. You remember it, don't you? The Tea Party, the Occupy Wall Street movement, the strange alliances and sharp divisions, the frustration that shaped election slogans, and the tone of national conversations for years to come. Because once trust breaks, it takes more than policies to fix it. It takes time, honesty, a willingness to remember. And maybe that's why we keep telling the story of 2008. Not to dwell in the pain, but to keep the memory sharp. So we do not sleepwalk into the next disaster, lulled by the rhythm of a booming market or the promise of endless growth. We remember because the warning signs were there. The flashing red lights, the reckless loans, the shadowy bets, the silence from those who should have known better, and yet we ignored them. Or we believed someone else was watching. That too was a lesson. No one cares as much about your money as you do. Not the bank, not the government, not the talking heads on cable TV, which means ordinary people had to become smarter, tougher, wiser, and many did. They started asking questions, reading the fine print, teaching their kids about savings and credit scores. Not all at once and not perfectly, but slowly, steadily, we got better at recognizing the signs. It did not make us immune. There will be other bubbles, other panics, but maybe the next time, we will see it coming a little sooner. Speak up a little louder, act a little faster. Because history does not repeat, but it rhymes, as they say. And in the rhythm of those rhymes, if we listen carefully, we might find the space to act differently. I think about that a lot, especially now when new risks emerge with every headline. Crypto, AI, climate disruption. There's always another big thing on the horizon, promising to change the world or ruin it. But this time, we carry a map, a scar, a memory etched not just in books and documentaries, but in lived experience. And that memory might just be our best defense. Goodnight, Wall Street. So now, as the screens go dark and the headlines fade into quiet, we end the story, where most stories about money do not with numbers, but with people. People who lost homes, but found strength. Who saw their retirements shrink, but still woke up the next morning to make breakfast for their kids. People who stood in unemployment lines wearing ties because hope dies last. The crash of 2008 was not just a financial failure, it was a reckoning. A reminder that even the most powerful systems in the world can break if no one's minding the store. It reminded us that markets run on faith, that safety is an illusion if it is only measured in profit, that when someone tells you, "This can never go wrong," they are usually selling something. And yet through all of it, the world did not end. The lights stayed on, the mail still came, the coffee brewed in the morning, and kids still learned how to ride bikes, because life somehow continues, even in the rubble. Maybe that is what resilience really means, not bouncing back, but choosing to move forward, even when the road is cracked. You and I, we lived through this story. Or we remember someone who did. Maybe a parent who lost their job, a friend who had to move back home, a neighbor whose house sat empty for months. We remember not just the facts, but the feeling. And tonight, as you drift toward sleep, I hope that memory feels a little lighter. Like a page you have turned, not one you are stuck rereading. Because the truth is, history never truly leaves us. It curls up beside us, hums quietly in the background, and waits. Not to haunt, but to help. To remind us what we've survived, what we've learned, and how far we have come. Sleep well, my friend. We will face the next storm together. Good night.